Good morning. Wanted to take a couple of minutes today to talk about what seems to be an ongoing concern for a lot of people. Just recently, I was talking with a friend who expressed his deep concerns, real deep concerns about the possibility of an upcoming market crash and seeing home prices drop drastically. Now, we can't rule that out. We just don't know what the future is going to hold. And the markets right now are they're kind of wild. It's tough to tell. But there are things that we can look at that may give us some clues about whether we're in the same situation now as we were back in 2007, 8, 9, when the market did indeed crash. So, are we going to end up back in that spot again? Well, one thing to think about is why the market behaved the way it did back then. At its very base, it wasn't so much a problem with the housing as it was the banking. Because at that time, many bankers were lending money under very risky circumstances. So, how has that changed? Well, several times a year, the Mortgage Bankers Association, or the MBA, releases an index that they call the Mortgage Credit Availability Index, or MCAI. Now, according to their website, this provides the only standardized quantitative index that is solely focused on mortgage credit. The MCAI is a summary measure which indicates the availability of mortgage credit at a point in time. Now, that's their definition or their explanation. So, what this is doing is it's saying, okay, how fast or what they're saying, how available was credit at a point in time. So, if you think of this as something that is tracking your speed over the course of an entire road trip, you're going to see that there are highs and lows, and those trends are interesting. But at any moment, it tells you that you were doing 45 miles an hour, or 55, or 70, or 10. The MCAI is telling us what the specific availability of mortgage credit was at a specific time. So, what that's doing is telling us how easy it was or is to get a mortgage. The higher the index becomes, the more available credit becomes, or mortgage credit becomes. So, let's look at a graph of the MCAI dating back to 2004 when this data first became available. Now, notice here that the graph shows that the index stood at about 400 in 2004. Mortgage credit became more available as the housing market heated up. And then the index passed 850 in 2006. So in 2004, it was about 400. In 2006, it went past 850. Now, when the real estate market crashed, so did the MCAI as mortgage money became almost impossible to secure. There was so much uncertainty in the market that lenders were not going to give money to anybody, it seemed like, because they didn't have any confidence that they would be repaid. We're happy that since then lending standards have eased a little bit, but the index is still very, very low. In April of this year, it stood at 121, which is about a seventh of what it was in 2006. What does that mean for a buyer? Well, simply that in 2006, just about anybody could borrow money very easily. And now it's not so easy. Now, why was it that the availability of loans was so high at that time? Well, it had to do with the very, very weak lending standards. To keep up with the demand in 2006, many mortgage lenders offered loans that put very little emphasis on the eligibility of the borrower to actually repay the loan. They were approving loans without always going through the verification process. People were able to borrow what, in retrospect, seemed like ridiculous amounts of money without proving that they could ever pay it back. So, as an example of the relaxed lending standards leading up to the housing crash, we can look at the FICO credit scores associated with loans. Now, what's a FICO score? Well, the website MyFICO says this, quote, A credit score tells lenders about your credit worthiness, how likely you are to pay back a loan based on your credit history. It is calculated using the information in your credit reports. FICO scores are the standard for credit scores, used by 90% of top lenders, unquote. So that's FICO. It's a system of credit scoring. Now, during the housing boom back then, many mortgages were written for borrowers with a FICO of under 620. Now, there are still some loan programs out there, excuse me, that will allow for a 620 score. It is possible. However, today's lending standards are much tighter. Lending companies, institutions overall are much more careful about who they give those loans to. So according to the latest housing debt and credit report from the New York Federal Reserve, the median credit score on all mortgage loans originating in the first quarter of 2020 was 760. Now, the graph we're looking at now shows the billions of dollars in mortgage money given annually to a borrower with a credit score of under 620. So these are those poorly qualified buyers. And look at the differences here. In 2006, buyers with a score under 620 received $376 billion in loans. In 2021, that number was only $80 billion, and it's only $20 billion in the first quarter of 2022. So what does this all mean for us? Well, in 2016, the lending standards were much more relaxed, and there was little evaluation as to whether the borrower could actually repay the loan. Today, the standards are tighter. The credit or the risk is reduced for both the lenders and the borrowers. These two are very different housing markets from today compared to 2018. Or to 2006. The question then is, what can we expect in the future? Well, housing markets may well be leveling off, and we may see them coming down to some degree. We don't know. But we don't have the sort of banking risk that we had back then. That gives us a little bit more security that we're not going to see the overall market collapse. Now, we want to be clear about this. That doesn't mean everything is great in the financial markets right now. We know that it's not. We're seeing concerns about inflation. We're seeing concerns about what's happening with interest rates for home buyers. These are legitimate concerns. But rather than simply acting on a hunch as to whether something is going to go one way or another, the best thing to do is to gather the most reliable information we can get. To do that, it's worth it to take the time to talk with a professional. Now, talking with a realtor is a great move. I'm always good with that. But you may also want to take the time to talk with a mortgage lender to find out what they anticipate happening, what the options are, what can be done to help you be best prepared to make the move when the time is right for you to get your next home. So if you have any questions, if you just like the name of a good lender, please give me a shout. You can reach me at 801-556-2259. Y'all have a good day.